The views expressed on this podcast are those of the participants, not of Reuters News.
So at this point, the erratic policies of the Trump administration are providing this impetus for a more rapid move away from U.S. assets. Now, we'll see if that continues. We'll see sort of what that looks like over the coming months and years, but we may be in a much more rapid period of de-dollarization than we were seeing prior.
Gold is once again the prized asset for jittery investors. Instability and erratic price moves in stock markets and concern about the dollar have driven gold's prices into the stratosphere. But the price now looks inexplicable compared to other assets like oil and silver. What this all means for investors and the world economy is the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with Breakingviews columnists. And I'm your host, Amy Donlan.
And I'm Jonathan Guilford.
So Jonathan, gold has long been seen as a hedge against volatility, right? So in stock markets and other assets, as they're all crumbling, people just go for gold. And we've seen that in many different crises. But in recent months, it has broken from the pack. And I just wanted to run through some numbers with you here because I just think some of these numbers are quite stark. So over the past half century, an ounce of gold on average cost 21 times the price of a barrel of oil. But in recent days, the gold-oil ratio is now above 50 times. And it's the highest level ever apart from a very brief moment during the pandemic, in which, let's face it, we were all in lockdown. Nobody really knew when it was going to end. And this is I think the main concerns we have now, all right, is about tariffs. So yeah, I'm just kind of curious, what is your take on this surge for gold?
Yeah, it's interesting because there are times when gold sort of looks like it just moves around with what the broader markets are doing. So you get all this froth and enthusiasm. You have a bunch of people tuning into Fox News maybe, and there's a nice gentleman on the TV saying he'll sell you some gold. Always seems like a good punt. But there are also times when it becomes pretty strongly disengage from what's happening with the broader market. And you kind of see a bit of that recently. Gold just kept surging through the recent dip in the S&P 500. Obviously, stocks rising back up after new tariff news and so on. Always kind of a roller coaster. Who knows where that finally ends up? But I think, yeah, really what's been remarkable is the strength and the kind of durability of this surge in gold. Fortunately, we have somebody who has been keeping an eye on the broader questions at work here. Gabriel Rubin, our Washington, D.C. columnist, is joining us this week on the Viewsroom. Gabe, you are very welcome.
Always good to be here.
So, Gabe, I think it would be good to maybe start off with a bit of background here. You took a look recently at what's been happening just broadly in the gold trading price and maybe what that tells us about kind of what's going on in the broader world. Do you want to give us a sense of kind of when you started noticing this recent surge?
Yeah, I mean, it all has to do with the uncertainty that we are seeing in global markets, specifically related to the U.S.'s unprovoked trade war upon the world. And you saw a lot of spiking in the gold price throughout the month of April as President Trump was rolling out first his Liberation Day tariffs on April 2nd, then, of course, the pause about a week later. And throughout the month, as these sort of negotiations or lack of negotiations went on and global uncertainty related to trade continued, and yeah, it's a good hedge in uncertain times. It's sort of a hedge of last resort, which we can get into. But when there's times of uncertainty, when the dollar is falling, that is a good time for people to jump into the gold market.
And it's interesting, Gabe, right? Because as you said, we've seen this real surge, certainly in recent weeks and months. But we've also seen in recent years, right? Central banks have been stockpiling gold. Have they ever discussed what exactly they're thinking or what the idea is in kind of building up these gold stores?
Yeah, I mean, there was a big change in how the sort of global financial system was understood to work, the sort of unwritten rules of the game, or really written rules of the game, in the wake of Russia's invasion of Ukraine in 2022. When the U.S. and allied governments in Europe and elsewhere put very significant financial sanctions on Russia to attempt to sort of break it and break its economy and war machine. So there were seizures of 300 billion worth of Moscow's foreign reserves, held in banks across the world, which led to a cash crunch and accusations of theft from President Putin. But really, other governments started to sort of see that, other government bonds, U.S. treasuries, are not a hedge of last resort, right? Holding dollars is not necessarily a hedge of last resort if the long arm of the West's financial system or the U.S. itself can sort of go in and freeze those assets. So gold is a stateless hedge on all of this and allows foreign governments, foreign central banks, shouldn't say foreign, central banks throughout the world, to hedge that risk and to hold assets that cannot be frozen by another foreign government.
I'm so curious about that because it feels like basically there have been 3 historical events in the last 5 years that have determined more or less everything we always talk about on this program. And that's COVID, the invasion of Ukraine, and then now the recent kind of like tariff tantrum. And like you say, I'm fascinated by
Brexit too.
Yes, yeah. And like, you kind of look at what all of those things imply about either like the much further reach of government power and its ability to kind of like tear asunder what we kind of thought of as consensus reality, which I guess is what you're saying. People realize that shock in the kind of like international trade system after Ukraine. But it also like, I don't know, we're beginning to think about stuff like, oh my God, could the US default on its debt? Is sort of still at the fringes of the conversation, but it's stuff that becomes more conceivable with every passing day, right? And I just look at where gold is right now, and it doesn't feel like it's priced for Mad Max universe, right?
Yeah, look, this is going to be a long process. I sort of think about the Vladimir Lenin quote about nothing happening for years and then history all happening in 1 week. I probably butchered that quote, but essentially the point is things happen gradually and then they happen suddenly. So at this point, the erratic policies of the Trump administration are providing this impetus for a more rapid move away from U.S. assets. Now, we'll see if that continues. We'll see sort of what that looks like over the coming months and years, but we may be in a much more rapid period of de-dollarization than we were seeing prior to Donald Trump's return to the presidency.
Yeah, and just to add to that, I was talking to Jonathan about this. I was at a lunch with a fund manager who's like putting a lot of bets on gold. And he basically is sort of like preparing for the default of US debt, which I think we'd have a long way to go in terms of gold prices if that's what people were really expecting. But he was saying, and I think that lots of people do think this, is that the gold price is reflecting just how sort of panicked people are, that they're willing to buy an asset that doesn't really give them anything, unless the price just keeps going up, that it's just a matter of having something to hold on to in the hope that, in preparation for something really terrible happening. And I guess, Jonathan, I would love to bring you in here because I know you got some sort of interesting views on like what Larry Fink was saying about like cryptocurrencies and, what are the other options that people have apart from gold? If you wanted, like, what are the thoughts out there among investors in terms of, because it's not the only thing, right, that you could hold that is not exposed to the dollar.
Yeah, because BlackRock is, it feels significant that we're at a stage where BlackRock, this titan of traditional investing, the godfather of the ETF boom, very much kind of straight down the line, like regular equity portfolio kind of investing, like, that you have them really kind of pushing this crypto angle these days. And I think was, to my memory, was talking a bit more about kind of, countries where there's more fundamental questions about state capacity and rule of law. But, I think he was making this point that Bitcoin, to a certain extent, is that kind of fear asset that you're talking about gold being. It is that, maybe that stateless hedge against whatever a state might do. Now, Bitcoin, to be clear, I'm, currently staring at a chart of Bitcoin price versus QQQ, the tech ETF, and there's a reasonable amount of correlation between those lines. Like Bitcoin is still more or less a frothy asset that moves in the way that frothy assets do, but you can kind of see maybe the beginnings of something there that's a little more substantial, and you kind of have the CEO of Tether kind of running around saying like, oh, we are a hedge against de-dollarization in emerging markets because we issue a stable coin. So that is, a cryptocurrency that is one-to-one backed by, US dollar assets, or I guess in theory that's eliding a lot of complexity there. But, you can exchange, a Tether or a Circle coin or what have you for $1 of value. And that is also a way to kind of, move stuff across borders, to handle remittances, to protect your wealth against, whatever is happening in country X. So and the market caps of these things have gotten substantial. I think USDC is like 60 billion. Tether is like, going by memory, roughly 150 billion. These are pretty substantial assets and stores of value at this point. So you do see this kind of creeping in across a few ways, but obviously the gold rally specifically is just monumental in terms of what's happening on a value basis. Because I mean, Amy, you and I were chatting about before this, relative to other assets, to which you might traditionally think of gold as being correlated, it's gapped out substantially, right?
So I think there's one important point to add here, which is that while gold is certainly a stateless hedge, it does behave in ways that are related to the dollar, because it's usually denominated in dollars. And as a result, when the dollar is weaker, people buy more gold. So you have sort of these dual forces, the uncertainty, which is of course leading to de-dollarization in the first place. But there are multiple sort of aspects of uncertainty pushing people into gold. And the fact that the dollar is weaker makes it, instead of flooding into U.S. assets, which would of course strengthen the dollar, they're instead going into gold, because the dollar is weaker.
Yeah, it's interesting. You kind of think what is gold actually useful for? And for the most part, what I think of is wearing it. I realize there are also other applications, but you kind of look at the influence that this might have over, say, luxury groups. I know, Amy, you were taking a look at Richemont, which sells a lot of jewelry made of gold. How are these moves likely to affect luxury companies for whom gold is actually a meaningful input?
Absolutely. I mean, I think that luxury stocks, they didn't need any more bad news in terms of, China being weak. The US obviously is also weak now as well. And then for certain luxury groups like Richemont, for example, that sells an awful lot of jewelry, the price of gold, those input costs are a factor. Now, they actually, in their most recent results, did actually okay, but they did talk again about this issue of the input costs going up of this, key thing that's one of the biggest drivers of their growth is their jewelry department, and, how they're going to manage that. And they obviously don't want to lose share. And they have this sort of funny pricing model where if they increase prices in one part of the globe, they have to increase them everywhere. So that doesn't really allow them to kind of, if they're, if they're doing badly in China, but they need to offset some things in the US, they can't really move prices around. So yeah, it does actually have a sort of an impact on the companies that use it as well, not just the people who are buying it. So I think, yeah, it is interesting just to think about, where that goes. If the price keeps going up for those companies that are really reliant on it, that will start to cause an issue for their profitability and most likely their sales.
And I think that makes gold such an interesting asset class because of who holds it. 46% of gold in the world is used in jewelry. Another roughly 20 to 25% is held by central banks, another 20 to 25% by other investors. And then you have industrial uses various industrial uses in manufacturing, but also dental implants. So that's sort of the overall landscape of gold, which makes it different from so many other commodities and certainly different from any currency.
I gotta admit, I'm actually a little surprised by how much gold is being used for something ostensibly useful, going into a product as opposed to just being a store of value. This is the thing. It all poses the larger question of where we go from here, right? the US dollar is still swinging around on the basis of whatever the latest tariff news is. And you can look into the past and see, like, oh, there have been these big gold moves during periods of uncertainty for the international system, for the end of the Bretton Woods system, for, you know, that kind of like oil crisis, Volcker shock era, for, you know, the financial crisis, times when like faith was really shaken. If trade wars die out, we see a deal between US and China. Like, does everything just normalize here? Or do we reckon, like, more fundamental questions have been raised now and you can't really put that back in the box?
My hunch is that, this train has left the station. And that doesn't mean that you're going to see a complete decoupling away from the US. In fact, I strongly doubt that that's what's going to happen. But clearly, people are looking for these stateless hedges. Clearly, crypto continues to grow. That train has certainly left the station. So the idea that everyone is just going to go back into treasury bonds, once Trump is out of the White House, or once, the trade war reaches some sort of comfortable equilibrium, I don't think that's true. I think we'll see some rebounds, but I think overall, the direction we're heading is in a de-dollarization direction. How fast we get there and how far we go is the open question.
So if you're right, though, Gabe, in those stats you had, which is how much people actually spend on gold, as in wearing gold. So if the gold price still goes up, you've got like real world practical situations where maybe you don't have gold as your wedding ring anymore. Maybe you have a different metal. Maybe you have silver, because there's quite a big gap between the two. But as you said, if things continue as they are, and people can continuously see the US and dollar as an issue, I think there is no reason why you wouldn't see gold prices increasing the way we are. Which I suppose, it's a problem if you're Larry Fink and you're still flying the flag for cryptocurrencies.
Perhaps. All right. I think that's as good a place as any to leave it. Gabe, thank you so much for joining us on the Viewsroom.
Good to be here.